with David Stockman. Hi, and welcome to the X22 Report Spotlight. Today we have David Stockman. David is a former Reagan White House budget director. David is a New York Times bestseller author, and his latest book is The Great Deformation, The Corruption of Capitalism in America. He's the creator and owner of the website David Stockman Contra Corner. That's David Stockman's ContraCorner.com. And I am very happy to have him here on the X22 Report Spotlight. Welcome, David.
Glad to be with you. Look forward to the conversation.
Yes. Now, we started out this year back in January, and this is when the president came out with his State of the Union, and he was telling us that the economy is absolutely fine. We're recovering. Everything's perfect. And the market went down, and then all of a sudden things started to improve. And when I say improve, when you look at the stock market, it looks like things are improving. But when you look at other economic indicators, GDP, unemployment, the real unemployment, and retail, housing, bonds, we see a completely different picture. When you look at the economy at this point, because a lot of people are scratching their heads wondering, what happened here? Why is the stock market all of a sudden bouncing back a little bit, and why are we at this point?
Yeah, those are all good questions. First, I think it was just a dead cat bounce, and now they've buried the cat for all practical purposes. You expect these in the process of a topping formation and the arrival of a bear market. I think we're in one because the world economy is in very bad shape. We're at the end of a 20-year credit bubble that has basically inflated the world economy beyond any sustainable level. We're now dealing with the aftermath, the day of reckoning, if you will. I think we're going to have a huge deflation for years to come. The peak of GDP level has been achieved. Corporate profits are going to be under enormous pressure everywhere. They're already down substantially. That's why I call this a dead cat bounce. So we just finished the fourth quarter. Everybody has reported now. GAAP profits, which are the real profits that you don't go to jail for if you report to the SEC, came in at $86.50 a share. That's down 18.5% from the peak, which was achieved in the 12 months ending in September 2014. So when profits are down 18.5%, when we have a gathering global deflation happening everywhere, I just came back from a 10-day trip in China, and I can tell you that is the world's greatest Ponzi, and it's going to collapse one of these days. There is no reason why the market should be even near these levels. The idea that because interest rates are low, therefore we should have abnormally high PEs or capitalization rate multiples, I think is absurd. The reason that interest rates are low is that we're heading into a great global deflation, the morning after this huge credit inflation. And that means there's danger ahead. That means profits are going to be under enormous pressures worldwide. And therefore, we probably should be valuing the stock market at an average or below average multiple, not at the absurdly high level it's at today. I'll just finish with this point. At the price that the S&P is at this moment, the market's trading 24 times trailing GAAP earnings. That is way over the top. That is in what I would call the nosebleed section of history. So put all of those things together, and I think you have a market that's waiting to roll over, and you have a market that's ignoring the reality that we have not had any kind of sustainable recovery except on Wall Street. Main Street is struggling, and I think that's maybe the issue we want to talk about further.
Now, do you see, bubbles, maybe in real estate, in student loans, in the auto industry? Do you see any of this?
Yeah, I think we have bubbles everywhere. The biggest bubble in the world is the global bond market. Central banks everywhere have driven yields so low that we now have the odd situation that traders are buying bonds for appreciation and stocks for yield. That's upside down. If you look at the world market today, there's $7 trillion of sovereign debt trading at negative yields. The Japanese bond market is probably the best case in point. Everything out to 10 years is trading at a negative yield. Now, Japan is a retirement colony verging on bankruptcy. It has, public debt equal, as people probably know, 240% of GDP, impossible to sustain or to finance. And yet the bond yield this morning on the 10-year Japanese bond is negative 10%. Now, how do you explain that? You can say the world has gone mad, it's irrational, and in some sense that's correct in the long run, but in the short run, it means the traders are buying the Japanese bond because they know the Bank of Japan is buying everything in sight, and yields will continue to drop marginally, prices will rise marginally. They're buying these bonds on repo, 95 cents on the dollar is borrowed, and so there's a trade. And this is what the evil of this massive central bank intrusion is all about. They have basically destroyed honest price discovery, accurate pricing in all the financial markets, and they created, I think, to answer your question, the mother of all bubbles in the bond market. Now that extends out then because government bonds are the benchmark or the yardstick on which, everything else is priced. And so junk bonds are dramatically overvalued, and we've got a huge junk bond correction in front of us. Real estate, by definition, is overvalued because it's priced off of cap rates, and the cap rate on sort of prime real estate today in the big markets, LA, New York, London, Shanghai for that matter, is 2 to 3 and 4%. Those are absurdly low cap rates, but they're derived from a global bond market that has been, as I say, totally destroyed and repressed by the central bank. So we have a real estate bubble, we have a junk bond bubble. Even in the case of autos that you mentioned, we have basically loaned money to anybody who, as I say, can fog a rearview mirror. And so we've had, since the bottom, car sales are up about 300 billion at an annual rate. Automotive debt is up by roughly 300 billion at an annual rate. So yes, we've had a big bounce back in car sales, but I think we have now basically reached a peak, and that is beginning to roll over too, because you can't loan money to people who are not creditworthy, even at today's lax standards.
Now, I don't know if you saw this, but Obama is to make it easier for
Yes.
people to get mortgages, where the government's going to guarantee a lot more of these. Now, if when this recovery that he keeps talking about, why would they do this at this point?
Yeah, well, I think it's the same old thing. We never learn any lessons. I think it's the bigger picture that we need to get a grasp on, and that is the mainstream opinion on Wall Street in Washington, let's call it the I-95 corridor, is that debt is the magic elixir that makes economic life go and economies grow and wealth to increase and so forth, and that is fundamentally wrong. We are tapped out everywhere in the world, but particularly in the United States, we're at peak debt. If you look at public and private debt, household, business, finance, and non-finance business, it's, as you might know, $62 trillion today. That's 3.5 times GDP. That's off the charts, the highest level we've ever been at. And the economy is simply sinking under the weight of all that debt. Yet, policy is oriented to somehow finding a way to encourage people to borrow more. That's what this housing thing's all about. Every creditworthy person that wants to buy a house has bought a house. Every credit or non-creditworthy person, household that wants to buy a car has. And yet the Fed sits there and says we don't dare allow the money market rate to rise above 38 basis points. And we have the Congress and the Obama White House saying, gee, we just need to get people to borrow some more money so we can get this economy moving. It's all a huge error. It's been going on now for 20 or 30 years. I think we're at the end of, we're at the end of the rope on this thing. And we're going to be facing some pretty unfortunate consequences as we go forward.
Now, Japan, Europe, they're all in negative interest rates right now, and the Fed increased the interest rates here in the U.S. Where do you think they're going to go with the interest rates here in the United States? Do you think they're going to increase them once again, or do you think they're going to bring them back to zero or negative?
Well, those are all the questions. On the negative, I think it will not happen here. It's kind of absurd to think that you're going to essentially charge people to save money. That's really confiscation of wealth. And my point is, in the United States, if they cross that line, right now they're already savaging savers. You know, when you have a 38 basis point money market rate or less than 30 basis points on, let's say, a 6-month CD, you're basically setting people who've spent their life prudently saving and want to keep their funds in a available liquid form. If you cross the line, though, and go into negative, that will be a screaming statement that the central bank in Washington is confiscating the wealth of Main Street America. And I think some politician, maybe he's called the Donald, will react rather violently and loudly to an effort of that sort. And we will finally get this issue on the table. You know, if the Congress were actually to legislate, and this is a huge redistribution of wealth from savers, tens of millions of savers, to the banking system of Wall Street, essentially, because it's Wall Street that borrows the overnight money in order to engage in the carry trade. But it's a massive redistribution of wealth to the 1%. And if you put that on the floor of the House or Senate for a vote, it would be shouted, with great disdain and anger. But the central bank does it because somehow they have attained this massive discretionary power. If they try to go to negative interest rates, I think they're going to finally incite the public, wake up the public, let's put it that way. The torches and pitchforks will come out and we'll have the issue joined. Now, whether they cut interest rates back to 12 basis points from 38 or wherever they're averaging today, I don't think makes any difference. But I do believe the Fed is basically run by clueless Keynesians who are living in a time warp, a 1960s world that no longer exists. And the idea that they can manage the GDP to the 10th of a basis point or the inflation in a global economy with a massive trade that exists, a massive capital and money flows that exist, I think it's just complete nonsense. And we're basically disabling capitalism. You know, part of capitalism is the financial markets. That's how we grow, when capital is allocated efficiently, when people are rewarded for true investment and savings. That capital market now has been totally destroyed. It's been turned into a casino. Stock prices aren't real. They're just traders and, robo machines chasing the latest pronouncement of the Fed. Bond prices can't be real. It can't be true that the feckless governments of the world are entitled to borrow at negative 10 or 30 or 50 basis points. So if you think about it, you realize that capitalism, which is the source of the prosperity that we've had, has been disabled because at the very center, the financial markets, we have this massive central bank intrusion.
Can the central bank keep the economy going the way it is, or do you think, or are we in a recession, or do you think we're heading to a recession/depression?
Yes, I think we're heading to a sustained recession of a different type. I call it a deflationary recession. I don't think it's going to be some kind of V like we've had in the past. I think we're just kind of grinding the economy to a halt because there's too much debt, too little investment, too much government welfare and handouts, too much regulatory and tax interference. The whole supply side of the economy is being punished. And basically, people are being rewarded for speculation. And wealth has never been permanently created by speculation. You can get bubbles, you can get temporary highs, but you can't get permanent wealth by speculating, leverage speculation, which is essentially what we have today.
Is this depression that we're heading into, is this going to be like 1929, 2008, or is it going to be better or worse? Where do you see this heading?
I think it's something different. I guess, and maybe that isn't a satisfying answer, but we're in a place we've never been before. We have never had central banks take their balance sheets in 20 years from about 2 trillion in 1995 to 21 trillion today. Never happened. We have never gone through 87 months of zero, effectively zero money market rates, even during the lowest point of the 1930s. You can check all the facts. So as a result, also, we've never had a credit bubble in the world economy, anything close to what we've had. There's now 225 trillion of debt, if you can imagine a number that big on the world economy. So what I think that led to was a one-time boom that now is going to unwind. And that's why we've had the commodity collapse. That's why we've had so much excess investment. We call it malinvestment, which means there's going to be a huge extended depression in capital spending. Capital spending is the lead element of an expanding economy. When capital spending is as negative as it is in energy and materials and industrials and shipping, and I could go on, you're going to have an economy that will basically be struggling at the flat line or even drifting negative. And it will go on for years. And then there will be a great reset of valuation in the financial markets. The markets are pricing, as I said today, at 24 times trailing earnings. It's kind of crazy. But the markets are pricing earnings as if the world economy is going to bound along like it always has, or somehow, enter this thing called escape velocity and start growing again at a heady rate. Not true. The world economy, I think, is stopped growing and is going to be in a great twilight zone for years to come. And then, as this becomes more apparent and earnings do not recover, the traders are going to lose confidence in the central banks, and we're going to get a re-rating downward of multiples. Now, let's just say that the appropriate multiple is 15 times trailing or current earnings. That wouldn't be crazy by historical standards. That would mean S&P 500 at 1,300, not where it is at the moment, 2050 plus or minus. That is a huge step down from where we are today. I think that's maybe a measure of the magnitude of the correction that could lie ahead.
David Stockman, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
I think the main way is through my daily blog. It's called David Stockman's Contra Corner. You can Google it. We put up 10 articles a day. I usually write one myself. And there's an email distribution you just click on and you can get it daily.
Thank you very much for being on the Spotlight.
Great. Glad to be with you.
Thank you.